Welcome back to the Microlearning Institute. In this short tutorial we're going to look at an example called Tele and Vision, and this example deals with a number of different part disposal scenarios. In the question we're told that Tele bought 100% of the voting share capital of Vision on the incorporation of Vision on the 1st of January X2. We're also given the statement of financial position for the individual companies of Tele and Vision, as well as the consolidated group statement of financial position at the 31st of December X7. In the first disposal scenario, we're told that on the 1st of January X8, Tele sold 40% of its shareholding in Vision for $280,000. So Tele went from a holding interest of 100%, it sold 40%, so it went to 60%. Of course, Tele is still in control, so now we look at how we deal with this, firstly in the separate accounts of Tele. So the consideration, we're told, is $280,000, and the carrying amount is 40% of what we purchased the 100% holding for in the first place. Now we purchased it for $160,000, so 40% of $160,000 is of course $64,000. So the difference in the individual company accounts between the fair value of the consideration and the carrying amount gives us a profit on disposal in the individual accounts of Tele of $216,000. This profit on disposal is eliminated on consolidation. Next we look at the effect the same transaction has, but now in the group accounts of Tele. So again, the fair value of the consideration for the group is exactly the same as for the individual company. However, when we now calculate the carrying amount of Tele, we can see that it comprises ordinary share capital, and again we're given the statement of financial position of Vision, and we see ordinary share capital at $160,000. The reserves on the statement of financial position of Vision at the date of disposal of the 40% interest is $240,000. So the fair value of the net assets of the entire company of Vision is $400,000. 40% of that fair value net assets is worth $160,000. So if we got a consideration of $280 for a 40% holding, which was valued at $160, we can see that the group gain to equity is $120,000. Now, it's important to recognize that this is not classified as a profit on disposal, because we as in the Tele group, still control Vision. So in this case, it's treated as a movement in equity, and here it's a gain in equity where we receive a consideration of $280,000 on the disposal of fair value net assets with a carrying amount of $160,000. We can now prepare the consolidated statement of financial position for the Tele group post disposal of the 40% share. So we can see that the Tele group is still in control of Tele, obviously, and is also in control of Vision. So we'll consolidate both companies entirely. Firstly, we'll remove from the books of Tele the investment in Vision. So again, we've removed a value of 64 from the original carrying amount of 160, leaving us with an individual company account value in the books of Tele of 96. Now this amount is not consolidated. The current assets in the individual accounts are $1,000 or $1 million in the books of Tele and $500,000 in the books of Vision. Now of course the current assets are augmented by the cash that was received for the sale of the 40% holding. So the current assets consolidate to $1,780,000. giving us a total assets of $1,780,000. Ordinary share capital, as usual in this case, is the ordinary share capital of the holding company, which is Tele. The reserves now, we can see the individual company reserves of Tele are augmented by the individual profit that's recognized in Tele on the disposal of the 40% holding. The reserves of Vision, we're told in the individual balance sheet of Vision, is 240. However, the consolidated reserves as at the 31st of December X7 of 800 are now augmented or increased by the group profit on the disposal of 40%. So we see the consolidated reserves is 800 plus 120, which consolidates at 920. Similarly, the current liabilities in the individual companies are added to give us the consolidated amount, and the non-controlling interest now equates to the non-controlling interest share, which of course is now 40%, of the fair value of the net assets. And again, that's made up of ordinary share capital and reserves, which are 160,000 and 240,000 respectively in the individual accounts of Vision. So this consolidates at $160,000, giving us a total equity and liabilities of $1,780,000. Next, we look at a different part disposal, and this time we look at a disposal from 100%, which is what we already own, to 40%. So in this case, we're disposing of 60% of the holding. So in this case, we're losing control. So we're crossing over the control threshold of 50%. We're going from a holding of 100% where we have control to a holding of 40% where we don't have control, but we have what we can consider to be significant influence, i.e. an associate relationship. So firstly, let's look at how this disposal would look on the individual accounts of Tele. So again, just as before, the fair value of the consideration in this case for the 60% of the shares that we had purchased in Vision is $440,000. The carrying amount is 60% of the 160 that we paid for them, which is $96,000. So in the individual company accounts of Tele, we recognize a profit on the sale of the 60% share of $344,000. Next, let's look and see how that would look on the group accounts of Tele. So again, we look at the fair value at disposal. Now, because we've crossed the control threshold, we have to remeasure everything to fair value. So we look at the fair value of the 60% that we've sold, and of course we've received $440,000 for it, so its fair value is deemed to be $440,000. And we also consider the fair value of the remaining 40% that we now own. So, and again, the fair value of that 40%, we're told in the question, is $200,000. So the fair value of the 100% of the assets of Vision at the date of disposal is $640,000. We must now look at what are we carrying these assets at, and the carrying amount is made up of ordinary share capital in Vision, which is 160, and reserves at 240, giving us a total of 400. So in order to calculate the gain on disposal, we compare the fair value of the entire entity of Vision with the carrying amount on the statement of financial position, and we see that we make a gain on disposal of $240,000 on disposal of the 60% holding of Vision. Now you can see fundamentally how this working differs from the working where we retained control. Where we retained control, the gain was taken to equity. Where we lose control, the gain on disposal is recognized in reserves. Now, let's look at preparing the consolidated statement of financial position now for this scenario. And here we can see that we no longer control Vision, because again we now only own 40% of it, so we don't have a controlling interest. So again, our investment figure in the individual books of Tele is reduced by 60% consequent to the disposal, so now sits on the individual accounts of Tele at $64,000. Again, as previously, this investment is not consolidated. The net assets are made up of the net assets of Tele. Now, we don't consolidate the $500,000 assets of Vision because we don't control that. However, we do add the $440,000 in cash that we received on the disposal of our 60% share. So our other net assets consolidate to $1.44 million. Our investment in associate now, we're told, is valued, the 40% that we're left with is valued at $200,000 at the date of disposal. So this becomes our investment in associate now. giving us a total assets side of the balance sheet at $1.64 million. Ordinary share capital, as previously, is the ordinary share capital of Tele. The reserves now, the reserves of the individual company, Tele, on the disposal of the 60% share, we can see there that we recognize the profit on disposal of the individual company of $344,000. However, in the consolidated accounts, we recognize the gain on disposal of $240,000 that we calculate in relation to the group. So the reserve figure that's consolidated is the sum of the $800,000, which was the consolidated statement of financial position figure at the 31st of December X7, plus the $240,000 gain that we recognized on disposal of the 60%. Current liabilities, again, we only consider the current liabilities of Tele because we don't control or have obligations for the current liabilities of Vision. So that consolidates at $200,000, giving us a total equity and liabilities figure again of $1.64 million. Thank you very much for watching this short tutorial from the Microlearning Institute.